What is up, YouTube? This is the Working Investor. In this video, we're going to talk about the flexibility of the YIELDMAX cover call ETFs, where they're able to do opportunistic trades with different strategies. And we're going to talk about real play of this opportunistic spread that they're doing right now in Coinbase, in CONY. And we're going to go a little bit technical over here, so bear with me. This is a little bit more of an advanced video for my advanced option traders out there, but I'm going to try my best to break it down for you. Let's get into it. So you could see here in bold, obviously, like I said, on a February 28th, 2024, and this applies to all their synthetic cover call ETFs, including CONY, that there's a new update. Effective immediately, each fund will at times opportunistically sell a call credit spread, call credit spreads. There are a lot of videos out there that explain call credit spreads. We'll see, maybe we'll touch on it a little bit. But so as a result of this opportunistic strategy, rather than capping the fund's potential gain within the value of underlying security shares increases, the fund may experience greater upside participation. So basically, let's look into the holdings of CONY, and you're going to see that they have not one, not two, but three different call credit spreads expiring this Friday. So I color-coded their spreadsheet. This is their spreadsheet that I had just to get the holdings. And on the top is in yellow, those are the puts, and on the bottom in light blue or purple, light purple, are the calls. And those top and bottom portions that I just pointed out to you, that is the original synthetic position. So what they do is, the key is the bottom, right? So you can see here, they purchased two lots of calls. They purchased a 175 call and a 195 call. So instead of owning actual stock of Coinbase and then selling covered calls, covered meaning covering actual stock, we call it synthetic because it works like a covered call, but it's a synthetic, it's fake, because they actually, instead of owning the underlying, they control the underlying. So they purchased these two lots of calls. They staggered it. Instead of kind of spreading out the risk, a 195 and a 175. Correspondingly, and I read through their prospectus, they mentioned in their prospectus or prospecti, because it applies to pretty much all the underlyings of the synthetic cover calls, that for the same strike price, pretty much, they also sell a put. So they're selling, or when I say put, I mean a lot with similar quantities corresponding to the call. So you see here a 175 call. You could see here October 18, same date, a 175 put. 195 call, 195 put. And they sell these puts. And when you see a negative number, to the best of my understanding, that means that they've received a net. So a positive number is what they paid for, and a negative number is a credit, just to make everything really clear. So when you sell, you'll see a negative. When you purchase, you're going to see a positive. If I am mistaken in any of these areas, you're more than free to point it out. I'm here to learn with you guys, but this is the best of my understanding. So they use the credit to offset the debit of the call. Now, this actually, even though they don't own underlying stock, but because they sold the put and purchased the call, it literally mimics real stock momentum. So when the stock goes up, its value goes up. When the stock goes down, its value goes down. And now what happened was, you could see here, I put in green and I put in red. The green, so basically there are three credit spreads, three lots of credit spreads that are expiring this week. And the greens are the shorts, which they sold, which they're getting money, they're getting a credit. And the red is the debit. And you can see here, it starts, the short starts at 160. That's the closest to the money short. Because remember, we mentioned Coinbase is trading about 155.05. And so basically we have $5 of leeway for Coinbase to go up. Now, this actually causes an opportunity. The reason why they did these 3 credit spreads is because they want to increase ways to make money, because the stock has gone against him. Because the stock originally, back in July, Coinbase was trading at around over $200 a share, and now it's trading, like you said, about 155. So let's look into. So I calculated 3 call credit spreads. If you add up the value, because you could see over here, if you go over here, you could see how much credit they got. They got $3.20 for the 160. They got $1.27 for the 167.5. And the 17, and for the 175 strike, these are all the shorts. They got 45 cents, and this is the debits which they paid, and together they have 3 call credit spreads. So a couple of things you've noticed: they're staggering everything. They're staggering their synthetics, and they're staggering their credit spreads. They're kind of spreading out the risk, which is in a way a cool strategy. So now, if you add up, I totaled up the total amount they received from the 3 credit spreads. And I subtracted the total amount of the debit of the long portions of the 3 credit spreads, and it comes out that they're going to bring in this week about $3.42.5 per times every spread they have for all their lots of spreads. So this is extra income they're bringing in because they have this opportunity, because they modified the prospectus. So now there are 3 scenarios. Now they're kind of basically hedging their risk. So what are the 3 scenarios? The 3 scenarios that a stock can only go up, down, or stay flat, right? So let's look at scenario number 1. If Coinbase goes down, then obviously we mentioned the synthetics are going to lose, right? Now I want to show you an illustration of what I'm talking about when I say synthetics are going to lose, right? So we're gonna literally mimic what they have there. So they have October 18, and of course they're staggered. So we'll just look at the 175. So let's do a sell put. They sold a 175 put. Remember, there's 2 parts. There's a 175 and I think 195, but we're looking at 175 for simplicity. And then they bought a call, right? 175. This is not the money they paid, because they wouldn't have done this trade if it was so. They usually want to do it at the money, not so far when they're underwater. But you could see here, I just wanted to show you for illustration purposes that when you sell a put and buy a call, as the stock goes up and down, the price action goes up and down, your value goes up and down. It corresponds. That's why I wanted to show you this illustration. I also wanted to illustrate to you that the mechanics that it seems like they're using is $10 wide in the spread. Why do I say that? Because look at the first spread. You see the 160 call? So that they sold a call at 160. When you do a spread, you sell a call and then you buy a call. That's called a call credit spread. And you can see here, $10 further out, they purchased the 170 call, right? And then you could see here the 167.5, and then look at this, $10 out of the money further out. So the spreads are $10 wide, 177, and here you could see 175, 185. So these are the 3 spreads. So I just want to show you for illustration purposes. Let's look at a call credit spread of this week. Let's say you don't have YIELDMAX and you just want to do your own strategy, right? So let's go back for a second. I don't know why it's jumping over here. Let's go to trade options. We're going to go to this Friday, and as you can see here in the middle, I guess it moves, it's dynamic. So Coinbase is trading at 155.20. And again, these numbers are off because these numbers reflect end of market day yesterday. Right now we're pre-market. So of course, if there's any movements overnight, the prices of the premiums will change. This is not market prices. But let's say you wanted to sell a call credit spread exactly like Coinbase, 160, I believe it was 160 to 170, right? So right now, 160, the delta would be 0.37. I'm not sure they opened it. Obviously, they didn't open it today. They opened it yesterday when it was somewhere else. I think they opened it yesterday. I have to look back. So you do, well, that's wrong. You go to sell call. So you're selling a call at 160 and you go $10 further up. And that's what they're doing. They're doing buy call 170. So they're getting premium. You're receiving a net premium of $3.20 per share, or $320 for a contract. And they're paying 96 cents or $96 per contract. And that's called a call credit spread. So basically, you could see as long as the price of coin stays under the short is what you sold, you're okay, you're golden, you'll be 100% profitable at expiration. But once it passes the short, then you're at risk. And then once it passes the long, then you're pretty much like at max loss for the most part. So yeah, minus the credit you received. Yeah. So basically, I want to go back over here, and let's talk about the three scenarios. So the three scenarios is, let's say if Coinbase goes down, obviously the synthetic, as I showed you, would go down. It would follow suit and go down in value. But the call credits are actually going to be 100% profitable. That $3.42.5 per share per spread will be 100% profitable. So even if Coinbase goes down and you're losing value, that's here to give you some buffer. If Coinbase stays flat, the synthetic is still going to lose a little bit, not because of the price action, because of theta decay. You lost a week of progress, but not as much. But if the Coinbase stays flat, then you're going to see that the call credit spread will expire worthless, because right now it will be, if it's under 160, it expires worthless. And remember, they staggered it. They staggered it in three sections. So, none of the call credit spreads will be at risk. None of them will be challenged. If Coinbase goes up, and even if it goes up a little bit, who cares? But if it goes up past 160, it blows past the first short, then number one, you can lose everything. Not everything gets a loss. Number one, the synthetic will go up in value because Coinbase went up in value. So there is a silver lining, right? But some of the spreads, not all the spreads will be challenged. Only the first leg of the spread will get challenged. Let's say it goes to 161, right? But the other one, the other two spreads, the 166.5 or I think it was the 170, the other ones that are further up, they will not be challenged. So, but if they do blow up 160, the other spreads may be safe, depending on what magnitude it goes up. Coinbase synthetic will increase in value, and the fund managers could still manage it. They could decide if they'll take a loss, it'll just be a wash, or they're going to roll it. They have a lot of ways, or they can close it. They have ways to manage it, or just wait and see. So there is a lot of ways to manage it. But this, the point I want to make over here is like just going back to the prospectus, and you can see it playing out in real time, that this opportunistic play really, 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 really helps. It really does help. I just wanted to show let's talk a little bit about AMZ. I wanted to show you for illustration purposes. I don't know if I have a spread over here. I did download it earlier. But the point is, AMZ is not doing they're not doing the call credit spreads, because AMZ is right now in the money. But I wanted to point out that they're just doing the synthetic on AMZ because I guess they're not as challenged. But this is really, really cool, guys. This is really cool. This is another tool in the tool belt, because if they wouldn't have had this tool of this opportunistic play, then as the stock goes down and down and down, you're only going to lose, because you're getting further out of the money, and they can't sell the synthetic cover calls profitable enough at the cost basis. They'll have to maybe go below the cost. I don't know what they'll do, But it gets kind of tricky. But here you have other ways to profit. You have other ways to profit, which is awesome. It kind of hedges against losses. Anyways, I hope you guys find this helpful. Have a wonderful day. This is the Working Investor over and out.